a little bit up. Brent is at 92.81 this morning, and WTI a little bit behind at 91.45. That sort of dollar 50 spread between the two is holding in there. But we're trading a little bit sideways, I suppose, so far this week. A little bit down at the close from last week, but some profit taking maybe after a fairly vibrant last week. The average oil price so far this year at about $88 on Brent. So a good kick on from 2021. Let's kick off this morning, as I like to say in my little tweet, we've got Sydney, Saudi, and South Beach all together in 1.5 hour session. You can't beat that. Let's kick off with South Beach in Florida. Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Mike, this has really kicked off to being a kind of a bullish year, up $12 since January 1st.
Yes, Sean. I'm actually in Key Biscayne, which is the opposite of South Beach,
okay.
But that's okay.
Well, don't take away my headline. I mean, come on.
But it sounds great. I actually rode my bicycle this weekend. There was a marathon. I kind of checked it out. I don't run anymore, but I think your headline nails it. But I think the key thing, it's less of an if that Russia is going to invade. It's more of a when, because I've come around to, in all my research this weekend, that there's no way out for him now. He's painting himself into the corner, and I mean Mr. Putin, that if he backs down now, pulls out the troops, he's going to go down in history as just another taunting wimp of a dictator. And to me, it's just a matter of time. Look what's the timing here. The U.S. just pulled out of Afghanistan. He's been wanting to do this forever. He's pointed it out. The U.S. is looking weak. And the way I see this now, the oil market gets it. The oil market's priced in. The stock market doesn't get it yet. And not so much the oil market, commodities. So I'm not bullish crude oil, because what I'm seeing is happening here is it's probably a done deal, and it's going to really shift the world order of commodities. And I hope it doesn't happen, because I have a son in the military. He's a captain in the U.S. Army. I hope he's not in harm's way. And that's the key thing. Is the U.S. is little they're going to do here. This is a major situation. I think it's going to shift the world order. It's very positive for the United States. Yes, there might be a recession, but for the commodity producers, all the energy, all the liquid fuel in North America, and most notably the grains. I spoke to one of my good friends out in the Corn Belt yesterday. Right now, corn is double his cost of production. This is the highest price in years. I mean, that's wonderful. I think what's going to happen here is this is going to crush the euro, crush Europe. It's very good for the U.S. There might be a recession, but it's obviously good for commodity prices. And I think it's pretty much, to some extent, already priced in crude oil. But that, to me, is the problem. Your first statement is less of an if and more of a when. So the key question I want to ask all of us is, what's his out now if he does pull out? He'll obviously, I think this is political and personal suicide for Mr. Putin, but it's too late. He's already amassed on the border 130,000 troops. Once the Olympics are over, mud season doesn't kick in until April. It's March is a time we probably can expect an invasion.
Let's go across the world to Sydney, where Peter Maguire, CEO, XM Australia, at least amongst this room, has the closest view of the Olympic Games, but still, I suppose, a distance from Bondi Beach. Peter, the year has started off a little bit soft in China. Of course, everything built around the Olympics. How do you see the first quarter vis-a-vis China, with the Olympics sort of sitting right in the middle of it? It's been a slow start running into it. Where do we go after? Your thoughts?
Well, good morning, everyone. Greetings from Sydney. Yeah, it has been a slow start, certainly, Sean, and where we're sitting as far as, equity markets. I think the shine has certainly been on commodities and what we've seen as far as price spikes for crude and a number of those major other markets. So I think the jury's out. We've had the Olympics, we've had Lunar New Year. China hasn't really engaged this calendar year, or our calendar year. So it's been a slow start, but I think they'll come out of the blocks fairly quickly come, say the early part of March, and the overall momentum to the upside, strong demand from crude, and overall, healthy economic situation moving forward. So I'm not expecting surprises. Building on what Mike said from a geopolitical stance and Putin and Ukraine, well, that changes the whole global scene. And we all understand the position as far as inflation, what the story is there. It's red hot, and what goes on as far as Fed and central banks agendas moving forward.
Well, on that point, Peter, how are the equity markets in particular currently digesting what seems to be every week yet another added rate rise for 2022 added to the bucket? And yet the markets are certainly volatile, but it's not knocking it over, so to speak.
Well, no, not yet, Sean. But I mean, that is, it's been bid up nearly every week because you had, 3, 4, 5, and then we had a possibility. And Jamie Dimon came out and said, well, maybe 7. So there's an 80% chance you're going to get lift off in March, 20% saying it's going to be a double hit, 50 basis points. So, as far as Powell's concerned, what goes on, we've got the inflation read coming out in a matter of days. The crude market is certainly worrying them from a price perspective and what impact it has to the consumer. And then you've got I'll listen to the interview this morning, Jeff Curry, just absolutely on fire. That was a number of hours ago. And, the critical shortfall you've got across all commodities and, base metals, and certainly from a demand side, very, very strong appetite globally for crude. So, yeah, we don't see demand destruction at the moment. I'm not seeing anything negative. So I think we're marching towards 100. Unfortunately, great for producers, but not too good for consumers, Sean.
Well, great for Wal Mahdi, maybe senior business editor, head of business section of Arab News. I'm sure the advertising must be pouring in to your newspaper, Wal, and I'm sure it won't be long that Saudi will be boasting a beach along the likes of South Beach and Bondi Beach, maybe Neom Beach or something like that, with all of the changes that are happening in the kingdom. But one thing that isn't changing is the oil output production. Saudi's holding that reins pretty tight, and as a result, we are in a tight market.
Well, this is the question that I've been asking myself lately. Why oil prices are in this bullish range, and why the market is tight, although OPEC Plus is still increasing their production, and some people were saying that we will see a surplus in first quarter, and the first quarter is about to finish, and we still didn't see the surplus. We're still seeing a tight market. One of the explanation that I can come up with is that the numbers are flawed. All the numbers that you hear so far from OPEC Plus are incorrect. This is a situation that we have seen historically in many times. Whenever there is a deal, I'll tell you the mechanics of all these deals so that you can understand how the situation is. So whenever there is a deal, countries will try to get out with the biggest quota. So what they do, they go when they negotiate at the beginning and say that their production capacity is let's say, for an example, is a country would say my production capacity is 1 million barrels per day. That's on paper. In reality, their production capacity, their effective production capacity is 600,000, 700,000 at max. And why they do this? Because when they, get the quota will go down to their maximum. So they will get a 300,000 cut off, and they will get a 600,000 barrel per day of quota. They will be happy. They think that they fooled everyone, and they are running at max. Now, when the market is always down, this is when all these quotas negotiation starts, because there is no demand. There is, prices are going down. That's why everyone goes to the quota system to make sure that, they don't push a lot of crude. But when the market picks up and we see demand increasing, we realize that many of these countries cannot increase production, although there is demand. And there is an obligation to increase production each month. But you see, many of them are capped. And this is the problem, because when you do a deal under OPEC Plus, everyone is rushing to do the deal. So everyone will accept whatever everyone is saying at face value, and they will go with the numbers. But when the deal, goes along, a few months later, we realize that there is not enough crude coming from OPEC Plus.
Well, on that point, why is Saudi with, you would assume their numbers are in and around correct. They have the capacity, but yet not willing to release more to the market at this time, and to a certain extent running a risk of playing at least a part in knocking the market over because of the high cost. Why doesn't Saudi, like they did on the downside, cut extra? Now there's an opportunity to win on the upside, pump more. Why don't they do that?
See, again, there is an issue of the allocations. If you want to increase production at this time, that means you are not going by the agreement. Therefore, other countries will do the same. Therefore, things will be hard to manage. I agree with you that on the downside, they have done this. Sometimes they go, voluntarily with an extra, but that's to speed up the recovery. Now the market has recovered. So do they need to do anything beyond the agreement? No. Saudi Arabia has done their part. I guess other countries should have done more. And other countries, actually, they cannot do more. Or they either manipulate.
Let's get Mike's view on that. Mike, do you think Saudi OPEC Plus is running a risk by not, if they have the barrels, trying to add them into the market at the moment when there's clearly tightness and demand for more, or in order to protect their gains rather than risk knocking the whole market over?
Oh, yeah. In the long term, they're becoming the ends to their own, the means to their own end. I mean, I always like to use the example of U.S. natural gas. It's the same price as 20 years ago. There's no cartel supporting it. It recently spiked in their 6. Now it's back to 4. It can't do it. There's not a cartel limiting any. Prices go up, supply comes back. Right now, what they're doing is incentivizing this massive global shift in electrification, decarbonization. Sure, in the short term, maybe a year or two, they can keep prices up. Maybe they stay at $100 a gallon, but that Ford F-150, the top selling vehicle in the US, they cannot make enough electric vehicles. Okay, and then you look at the supply side. I look at North American crude oil production this year is going to reach a surplus of 13%. That's Department of Energy estimates based on prices from the end of last year. Now we're 20% higher. So you have to assume elasticity of supply no longer matters. And that's one thing that Jeff is a personal friend that he's missed in the past. That's one thing I've been jaded with in commodities. You should be selling when they're yelling, and this is not a time that you get into a bullish. There's got to be a war. The market's priced for a war from the aggressor being the world's largest, one of the largest crude oil exporters. We have to remember what's going on, and what we're doing is, people call it demand destruction, but U.S. liquid fuel consumption peaked 4 years ago, and it's actually declining now. And the rest of the world's following that mode. Look at China. 20% of the vehicles sold last year were EVs. That's accelerating. So I like to say, OPEC, good luck. This unprecedented is great, but remember what you did in between 2011 and 2014? You just incentivized U.S. shale and Canada oil sands, and you're doing it again because those costs of productions are declining.
And do you expect, Mike, that we've had some debate over the last few days? We had Ryan Lance of ConocoPhillips warning or giving his sense that actually U.S. production could add over 1 million this year or close to it, 1 million barrels a day. Your outlook for shale and for U.S. production?
Absolutely. I like to combine liquid fuels, U.S., North America, because I'm from a farm background. We got to use ethanol and biofuel. It does cover almost 15% of unleaded gas in this country now. So this year, we're probably going to reach total production there, 28 million barrels a day. Total consumption peaked at 24 million barrels a day 4 years ago. Maybe that jumps up a little bit, but that's pushing on a 13% production gap. That's what I mean. If this war happens, for the U.S. commodity producers, this is such a boom for the dollar. And this is just, like I said, my friend in the Corn Belt, he's double his cost of production. And a lot of his corn is used for gasoline nowadays. And the demand for that gasoline has been going down.
Peter, just to welcome your thoughts jumping in there from the point of view of the outlook for the Ukraine crisis. Does it feel like the markets are pricing that in from your perspective sitting in Sydney? How big a deal would it be for the markets if indeed it happens as the American government is telling us every day that it will happen?
Well, I think, it's a tough one to to even think through, Sean, what impact it's going to have. I mean, Mike's sitting closer, from a state's perspective. Australia's very much out of that, I think.
Yeah, but we do have China giving Putin fairly robust support. I mean, he's standing with a fair wind at his back from Beijing.
Absolutely, got a wet sail and strong wind in his wet sail. So, as far as Australia is concerned, we're just sitting here observing from China's perspective. Yes, there seems to be a lot of push, and it'll be interesting over the next matter of weeks where Mr. Putin plays it. And if it's building on what Mike's suggesting, then we could well be in some form of situation by this time next month, or maybe to the middle of March. Who knows? I'm not expecting anything to escalate over the Olympic period. Who can tell? But what impact that has naturally to energy prices and to US dollar, and of course to equities, is going to be, I think, more volatility in the short run and big price moves. This changes the game considerably if Putin gets involved, because we haven't really seen anything in my lifetime where Russia's actually been, gung-ho in invading. I know they've done, they've certainly been aggressors, but this changes, I think, the footprint in everyone's viewpoint.
Well, it certainly would be a big deal. Well, what does it look like from the perspective, do you think, of Riyadh? Obviously, caught in some ways between a rock and a hard place here. Russia is your biggest partner in OPEC Plus, Saudi and US, of course, historical partners. What does it look like from there generally, and your outlook for how this plays? You're on mute, Wald. Sorry, you're on mute again.
Yeah, well, this is not the first time geopolitics is the name of the game for OPEC Plus and for Saudi Arabia. They have went through a lot, and sometimes internally, member countries were at war for 2 times. So it's not something new how they manage the situation. Look.
Of course, MBS went to Beijing, was there with Putin and the president of China.
Yes, there is. So everyone, I'm sure they have some kind of a contingency plan for all of this, and I'm sure that they don't want to see any escalation. To me, this is my views. I don't think that they want to see an escalation, because if in case of any escalation, the only country that will step in to compensate is Saudi Arabia, which means more pressure, more production, more work at home. So I don't think that they favor any situation. I'm sure that they are trying to, reason with everyone to make sure that the energy market stability is not affected, because to Saudi Arabia, it's not all about production. It's about keeping the supply secured. Energy security is one of the top priorities for Saudi Arabia, and whether under the G20 commitments or as an individual nation, because it has a lot of responsibility as a leader of OPEC and OPEC Plus. So
on that point, just to also comment on the other big geopolitical story that does seem to be creeping its way towards some kind of agreement, and that's the Iran nuclear talks in Vienna. How does that look to you at the moment, and where would Saudi's position be on that, do you think?
No, I think Saudi Arabia is, to me, as an observer, I think Saudi Arabia wants to see more stability and peace in this region. I'm sure they want to make sure that Iran negotiation goes smoothly and everyone agrees to good terms for many ways. First of all, you cannot keep Iran on the side for too long. They are an OPEC member. They need to come back to the market at one point. They need also to share some of the burden from other countries. Saudi Arabia cannot balance the world market alone. It needs, the production from everyone, including Iran. Now, whether there is some geopolitical tension or political tension between the two, that doesn't mean that on the oil front, they want to sideline Iran for too long. I'm sure that they are supportive of seeing Iran coming back to the market, but the thing is, it's not their call. It's the call of of Iran and the superpower.
Let's go to the survey question and let the room have a little bit of a view on where oil prices are going. Brent crude oil has averaged around $88 approximately so far this year. Started at 80, went up to 92, 93, where it is now, on average 88 approximately. What will the average price be for the whole of Q1? Will it be more than the 88? Will it be less than the 88? Or will it be essentially similar to that number? What are your thoughts on where do we go from here on the average for Q1? Obviously, we're trading above 88 at the moment, but so far, the first 5 weeks of the quarter, we've averaged at 88 on Brent. Will the quarter end above or below or similar to that? Welcome the views of this room. Mike, of course, everything in the US starts to turn towards the elections and the big price of gasoline. You probably can't look out your window without seeing a gas station. They're everywhere in a US street. But ultimately, how are the politics now in mid-February going to start to play into energy policy? I understand that Biden's even now asking US oil producers perhaps to add production capacity.
Yeah, it's about time he figures out maybe he can do a lot to add the supply. It's a lose-lose for the Biden administration, for the Democrats. Every time you look at the psychology effect of watching the unleaded gas go higher means less votes for the Democrats, because they're in power, they're being blamed for inflation. It's just a matter of fact. And at the midterms, you must always switch back to Republicans. We saw that in the recent votes. You were on top of that very well, Sean. So to me, this is lose-lose. And that's one thing that's negative for crude oil. The current administration has a lot of incentive to pressure commodities. And that's why I think there's what's going to happen is, unfortunately, I expect there's going to be an invasion. And that's going to just mean the U.S. economy will be going to a war economy in terms of not the arsenal of democracy, but the complete global supplier of commodities. I mean, ramp up, drill at will. You no longer pay farmers not to produce, and they'll have tons of profit. So the epicenter of global commodity production, which is becoming North America, will accelerate. The dollar will strengthen. But in terms of midterms elections, the Democrats are toast. It's going to be a push right back towards Republicans. Republicans are more drill at will, and it's just a matter of time. I don't see what saves them unless the gasoline, unleaded price of gasoline drops from around 4. It's 3.50 or so right now, back towards 3, and it's summer driving season's kicking in, and prices usually go higher for the summer.
Well, you'd certainly need a big shift for that to happen in terms of the gasoline price. Peter, looking at the currency outcome of all of this, obviously we've been through a very robust dollar strengthening cycle. Now we seem to have a pause. Where does it go from here, and what are its implications, do you think?
Well, Sean, what we've seen since Christmas has been dynamic as far as trading. We were at 97.4, I think, only a couple of weeks ago, or a week and a half, that US dollar index. And then it got spanked down 95.6 at the moment. So it's given up a lot, very strong move to the upside for pound and euro. So it's been a trader's delight. Where we move from here, I think a little bit further softness for that US dollar in the short term, though that does impact as far as if Putin moves quicker, then that's certainly going to, I think, push US dollar higher.
Would that be a natural flight to safety play, do you think? Anything crisis, this thing escalating?
I think so, Sean, absolutely. And naturally, if you see the US dollar shoot, then that could take a little bit of that heat off as far as some of those commodities. Keep an eye on gold also, and a couple of the other precious. But where I think the US dollar will continue, bit of softness, it was exhausted to the upside. It's going to whipsaw, and I think it'll be it's a high 90, mid 95s to say 94.8 over the next couple of weeks. I think we're all sitting here waiting to see what Jay Powell says and the inflation read this week, and just the overall global.
I mean, putting aside Ukraine, Peter, is this a currency, the direction of currencies, the major pairings based on who moves most first in terms of rate cycle? Obviously, the Brits moved.
Yes. Well, the Brits have moved, Sean. They've had 2 runs at it. We're still waiting for Jay Powell. There's very little chance that anything's going to happen out of Eurozone. So there's the storyline there.
But at least they're talking about it now.
Well, yes, they are. They're talking, but they're not going to be Action Jackson like what Jay Powell's going to be. And if you think of Jamie the other day, said Jamie Dimon, you might see 7 rate rises this year. Wow. I mean, he might front load. Who knows? I mean, I only listened this morning. And remember, you put your mind back to Alan Greenspan. I think it was 2000 or 2002, where he did a 50 basis point hit. So he double loaded, and that'll be 20 years. So maybe Jay Powell comes out swinging. There's a 20% chance that he'll do that.
I mean, it seems to me that if it was ever a time to do it, I don't know, everything's counterintuitive these days, but it seems to me that all the pieces of the puzzle are you front load here. It's not about how many times you do it, it's how big it is each time.
He's not going.
Well, that's true. It's going, Mike, going. Not going to happen. There you are. That's the voice from.
So we're in the jawboning stage right now, and it'd be ideal if the market's tighten for him. That's already started a little bit, but the problem is commodities going up is bad. It means he's got to keep tightening, but he will not go 50. You can hear if it does happen, you can blame me. It's virtually impossible. You start with 1 because that would be disrupting the markets. But he's jawboning. Look what the Bank of England will raise rates.
The markets are kind of I think
raise rates. The market will do it for him.
Yeah.
Let's go to Wal for last word. Last word in Riyadh. Well, let's get the survey result. Boom, boom, boom. What will the average price be in Q1? More than it is $88 average so far. This is a bullish room. It kind of feels that way for a few weeks now. Well, I wanted just to pick up one note on the news overnight that the Saudi Sovereign Wealth Fund, acronym PIF, has had a credit rating from Fitch and Moody's. Your thoughts on why that's happening and what that means for the kingdom?
Well, why that's happening? Well, the fund itself, they applied to be rated. They want to be rated because they want to expand their reach to other investors. They want to grow in an unorganic way. They want to reach to other investors. They want to also assure investors that there is some kind of governance and transparency in what they are doing. When you have a rating, it means that you are transparent to these agencies. They have done a thorough job. They went through your strategy, and they are happy with what they saw. Now, the other thing is also a bullish signal for the market to me. If you get a rating like this, it means that all these agencies believe that oil prices will stay high for some time. Finances will be there for the fund for a significant period. And it also can be seen as that Saudi Arabia is going in the right direction when it comes to diversification of their income away from oil.
Yeah, it's certainly, I think, a very positive indication for the kingdom, and inevitably everybody needs to move in that direction in the neighborhood. More accountability, more transparency. As for the oil markets, maybe that'll come sometime in the future. Mike McClone, thank you so much. Not in South Beach. Peter McGuire hasn't been to Bondi Beach in ages, I'm sure. Wal Mahdi, soon to have Neom Beach or whatever the equivalent may be. Between worldwide wrestling and concerts and I don't know what going on in the kingdom these days, it's certainly a changed place, and we look forward to. And my niece actually went there for the weekend recently, which is another counterintuitive. Yeah, I'm going to Riyadh for the weekend. I'd never heard that before, and there it was. So things certainly on the change. All the best. See you every morning, 10:30 UAE time. Thank you.